To understand the heavy machinery sector, you really have to appreciate the massive scale required just to operate. Today, we are looking at the financial engine of one of those operators, Happy Forgings, to see if their stock is worth a spot in your portfolio. They just dropped their latest yearly results, reporting exactly 16 billion rupees in revenue. That top-line number actually beat market expectations by 2.8%. When a heavy industrial company consistently hits these kinds of marks, we call it a steady compounder. It means the underlying business is executing its plan year over year. Their earnings per share came in at 31 rupees 92 cents. That landed exactly on the dot with what Wall Street analysts were modeling. While revenue outperformed, the fact that earnings landed exactly on target suggests the market has a very accurate read on this company's scaling costs. It proves the business is executing without the kind of operational friction that leads to negative surprises. But here is where we run into a fascinating problem. There is a glaring disconnect between the company's operational execution and how the market is actually pricing the stock. This quadrant chart plots revenue growth against volatility. Happy Forgings sits in the top left, high growth, low risk territory. Analysts just bumped up 2027 revenue projections from 17.8 to 18.3 billion rupees. Yet the consensus price target from those same analysts refuses to budge, stubbornly anchored at 1,314 rupees. If the company is outperforming peers and raising guidance, why is the price target pinned to the floor? We need to figure out if this is a hidden opportunity or a value trap tying up your capital. To answer that, we have to pull back and look at the broader capital goods sector. Right now, the wider machinery industry is moving at a reliable clip, expecting to grow revenues by about 12% annually. This bar chart compares that baseline against Happy Forgings. The company is projected to grow at a 16% rate. That 4% gap is your growth premium. It represents the extra return for picking this winner instead of the entire sector. But capturing that premium means choosing to hold individual shares instead of a diversified industrial ETF. You are taking on single stock risk. If Happy Forgings experiences a specific factory breakdown or a unique supply chain failure, your entire investment takes the hit. You have to decide if a 4% outperformance mathematically justifies leaving the safety net of a broad index fund. The argument for taking that risk lies in the company's internal efficiency. They convert raw materials into profit with mechanical consistency. Thanks to that efficiency, next year's earnings per share is expected to jump to 36 rupees and 7 pence. That represents a clean 13% increase in their actual earnings power. When you buy into a metric like that, you are purchasing operational predictability. You know exactly what the company is going to deliver quarter after quarter. The trade-off for predictability is the absence of explosive price action. By choosing stability, you forfeit the chance for rapid, parabolic moves in speculative sectors. A steady 13% compounder is never going to trade like a momentum-driven tech stock waiting on a massive news catalyst. This stock is designed to be a structural anchor that stabilizes your portfolio over half a decade. It is not a vehicle for quick, outsized returns. Which brings us directly back to Wall Street sentiment. Analysts know exactly what this company is, and their targets reflect the lack of surprises. This graph maps market predictions. Bulls target 1,650 rupees, while bears sit at 1,028 rupees. The 1,314 rupee consensus establishes a hard ceiling. Predictable revenue leaves no upside surprises. Conversely, the 1,028 rupee bearish floor provides strict downside protection against catastrophic collapse. You accept a severely capped short-term upside in exchange for limiting your exposure to a massive downside correction. The market has fully priced in the reliability of Happy Forgings. To see meaningful returns, you must be willing to lock up your capital for years and let the earnings gradually push the floor higher. So we move from the data to your actual strategy. Who is this stock built for? This decision tree flowchart breaks it down, starting with your primary investment goal. If you prioritize portfolio stability and steady EPS compounding, this is a perfect fit. Investors looking for growth at a reasonable price rely on companies exactly like this to consistently beat the sector average without adding unnecessary volatility to their portfolio. For a risk-averse, long-term investor, the complete lack of a surprise plot twist is the very reason Happy Forgings is a strong buy. Conversely, if your goal is short-term alpha or high momentum, holding this stock will feel incredibly frustrating. You will watch your capital sit stagnant while other sectors run. That cautious analyst consensus is a flashing warning sign that multi-bagger returns are virtually impossible over the next 12 months. Successful investing means aligning your capital with your actual timeline. A stock having a great earnings headline does not mandate a purchase. Happy Forgings is a tool for long-term compounding. Before you allocate a single dollar, look at your portfolio and honestly ask if you have the patience to let the gears turn.